Good morning and welcome to our webinar, Exit Rich, Retire Secure, with our host, Angela Hall. Angela is our senior financial planner here at Note, as well as our head of our 401k division. Angela not only works with individuals on their personal financial plans, she also works with business owners on choosing 401k/retirement plans for their own business. If you have questions throughout the webinar, you can type them into the chat or press the raise hand button and I will unmute you. So without further ado, here's Angela.
Good morning, everybody. Thank you for joining us today. It's a beautiful day here in Western New York. The sun is shining and we have no snow, so why not talk about our business? So today we are going to cover a few different topics. So I'm going to go in and we are going to start our presentation. Like Heather said, if you have any questions, please feel free to use the chat, or you're also welcome to contact me afterwards. So we are Note Advisors. We're located here in downtown Buffalo. We are on the waterfront. So really some of our core values here are intimacy, action, and development. We are a fiduciary, meaning our job is to work in the best interest of you and your loved ones. As Heather kind of alluded to, today we're going to talk about why your business shouldn't be your only retirement plan, how to turn your business profits into personal tax efficient wealth, strategies to reduce taxes through smart retirement planning, and how to align retirement planning with your succession strategy. I think it's always good to have some opening slides just to kind of talk about why is this an important topic. So recently I read some really interesting statistics. There's a lot of change happening in the small business arena. So one of the stats that really got me going is that 40% of the small business owners would like to retire within 10 years. 10 years goes by in a heartbeat. Why does that matter? 70% of you have no formal transition plan. So that's meaning more than the majority of people that plan to retire, sell their business, transition, have no plan. And only 8% are prepared. And those that are prepared have already started working with an advisor. When you're selling your business or you're thinking of transitioning, there are multiple different advisors that can take place. Thought this was a really good screen. I did steal this off the internet, but I thought this was a really great way to look at what are the pillars of selling a business. One, you got to be ready. So preparation. Do you have a plan? Do you know it wants to go to a family member? Are you looking for a succession? Are you looking just to be purchased? So many things to start to think about. And the sooner you can start, the better off you're going to be. Finding buyers. That can be a little bit more difficult. It's always good to start those conversations ahead of time. And that can be maybe you're going to an industry group where you have other peers. Maybe you're just out in your local marketplace. So there's a variety of different places to start that conversation. Deal structure, right? This is going to be kind of based off of what you think you want to do, right? You always want to be fair to yourself. And depending on who you're selling to, there could be a few different conversations there. We're going to talk about valuation. Do you know what your business is actually worth? That's a huge one. So many business owners that we work with say, my retirement plan is just to sell my business. And that's great. And that could totally work out for you. But right, we have to have a buyer. Just like anything, you have to have a buyer and a willing seller. Due diligence, right? Walk through your business. Make sure you know what you own. It's really important because if you haven't done your due diligence, if you come in with a buyer, they certainly will. And last but not least, transition. You always want to make a smooth transition. A lot of sales really will say, hey, we want your employees to stay. You, former business owner, we'd like you to stay on. So really just make sure you know what that transition looks like. So why your business shouldn't be your only retirement plan. Right. A lot of things can happen when you're looking at selling your businesses. Many of these are internal. So one, has there been a change in revenue trends or market conditions? What does that mean? That means, right, think of Amazon. So prior to COVID, really, people still went to a mall. They went to a store. Amazon was great. It hadn't taken off the way it has now. That's a huge market trend. Now, right, our brick and mortar stores, there aren't many left. I just watched a show this morning on Amazon's going to deliver everything through a small electronic airplane. So, right, we've had such a change in market conditions. Also, your employee retention. When you change market conditions, or has just the demographic of employees changed, right? I teach, and I will say, probably from when I graduated to the students that I work with now, there's really been a demographic shift in what they're looking to accomplish, fields they want to be in. So, really, has that shift taken place? And are you in a local area that can really substantiate having a constant flow of employees? This is a big one. This is discretionary spending distorting profitability. I know a lot of small business owners, this is their business, it's their livelihood. They've used it for, a variety of different things. But as you get closer to a sale, it's really important perhaps just to pay yourself what you think you should be paid instead of writing or using your business for multiple different expenses that may be a little bit more used on the personal side. Poor financial records, I shouldn't have to say too much about that one, right? Make sure your books are in order. If you haven't done like any corporate meeting books, you haven't updated stock, anything like that, it's really important to make sure those things are in place. Also, make sure you don't depend on just a few large clients and suppliers. I know the adage is 80% of your business tends to come from 20% of your clients. Same thing for suppliers too, right? And this also goes with the demographic changes, right? If we've seen recently some changes in tariffs, some shift in where things are manufactured, where raw materials come from, it's really important to look at these things. Carrying outdated inventory. I always laugh. This one made me think of Shark Tank. You always see the businesses come out and they say, oh, we have all this inventory. We have all these SKUs and nobody's purchased them. So, right, you really want to be cognizant of what you have sitting in inventory if that's applicable to you. Clear up any tax issues. I'm going to end there with that one. And really have a good understanding of what your business is worth. And don't wait too long to do this. So many people wait too long. They have in their brain of what their business is worth. They might say, oh, I think I'm going to get $5 million for this. Well, maybe some of the things listed up above haven't been put in place, you haven't addressed them, and really it's only worth maybe one or two. So you really want to make sure you're referring to somebody, maybe you're paying somebody to help you look at these things. So great, we've done all these things. It's terrific. Now, how do we turn these profits into personal tax efficient wealth? Now, the next couple slides we're going to go over are particular perhaps to the size of your business and to the structure. So we're going to start here with solo practitioners and independent contractors. One of the things that a lot of business owners kind of forget to do, because right, we're managing all those things in the previous slide, is we forgot to put together a retirement plan. Retirement plans are a great way to get some tax efficient wealth put away and can also help you and your employees further down the road. So one of the ones for these are really small solo practitioners, and again, those independent contractors, is a solo K. So solo Ks mean you have no other full-time employees. Perhaps you only use independent contractors, or perhaps it's just you and your spouse. That's a lot of small businesses. So you and your spouse can be on a solo K together. The great thing about this is you still get the benefits of having a full-sized retirement plan. You can contribute the maximum amounts, and we're going to go over that in another slide. You can use the catch-up provisions, which is great. Also, the profit sharing portion of it can really be effective because you're allowed to put up to 25% of your net earnings in there. So again, perhaps we've used the business to pay for some other expenses, but now we still have some earnings, some profits left. We can continue to use that. It also includes the Roth option. So a lot of people get this confused. They say, is this a Roth IRA? No, this is the Roth option underneath your 401k umbrella. So this is fantastic for those business owners and perhaps their spouses that have maybe phased out of the option of getting an individual Roth IRA. You can use it and fully maximize it in the retirement account. Super. The 5,500 and testing requirements, those only come when you reach a certain limit there, $250,000. And now with some new regulations of Secure 2.0, you can have loans also in the Solo K. Now, for those larger businesses, so, right, you've got more than you and your spouse. You are not an independent contractor. So, anybody from, you can have this with 5 employees, you can have it with 100, hundreds of employees. Now we're going to start to look at your classic 401k retirement plan. Also, a great way, one, to retain talent, to attract talent, and also to help you, business owner. So these are employer sponsored. So you, business owner, are the sponsor. And similar to our Solo K, we have maximum contribution amounts, catch-up provisions, super catch-ups, and we can also use the Roth here. Again, similar to our Solo K under that 401k umbrella. The best thing here, so Solo K will give you some ways to design a plan, but really it's you and a spouse, perhaps just yourself. It's pretty limited because you don't need as much. But when you're in a larger organization, right, then we can start to design a plan. Are we going to match? Are we going to add profit sharing? Are we looking at a safe harbor provision? You know, there's a variety of different things here that are really helpful. This is subject to testing. And again, these do get a little bit more complicated. That's why it's always great to talk to somebody, partner with an advisor who can really walk you through the steps. But the other notation here is we did have some changes with the Secure 2.0, where if you are somebody that's made over $150,000 in the year 2025, you now have to make those catch-up provisions into a Roth. So you will be using that Roth feature kind of whether you like it or not. So the next few slides are charts to try to show you how impactful these can be. So this one is particular to using the Roth Solo K and the profit sharing. Because remember, in addition to being able to put in a profit share, you can also put in as the employer and some catch-ups. So I thought this was a great way to say, hey, maybe we, maybe we had phased out of being able to use the Roth IRA. We're now going to use this Roth in the 401k because right now it's available to us under that umbrella. So here you can see 2025, here are our numbers, 2026, right? We had $1,000 increase, so it's $24,500. Be aware that this doesn't change whether you're using pre-tax or Roth. So these are just the contribution limits. Okay. Now, hello, Mr. Mrs. Business Owner. I work by myself or my spouse. We can make sure that we do that profit sharing up to 20% of our net earnings. Great. Fantastic. So, and then I'm up to 50 because I'm looking to put these things in place before I sell. Right. We have an extra $8,000. So really, you can see where these monies really start to add up, right? And these are on for the business, right? These are business expenses when it comes to the profit sharing contribution. So, right, all great things to start to think about. With the Secure Act 2.0, we also have what's called the super catch-up, where if you're between the ages of 60 and 63, so right, it's a limited time frame, you can start to add, instead of the $8,000, it's $11,250. So if you're somebody that fits into your budget, that really fits into your business model, great way to be able to put more money together. This one is just for our regular 401k. So kind of how this would work, taking into consideration just that pre-tax. So we've got our earnings here. This is pretty much, a good example of a normal business. And you can say here we are. Here's our contributions. We're going to do what's called a 3% safe harbor. So that can be in a non-elective, meaning you're just giving it to everybody. There is a matching formula that's a little bit different, but for this situation, we're looking at the 3%. Great. Similar to our solo K, we're going to do a profit sharing contribution. Fantastic. So then the company or the business put in 36,500. Our total contribution is 55,000. This is great, right? You've got two founders here. Now we're able to put 55,000 away. In addition, we're also helping our staff and our employees. So that's just a great way to try to illustrate what's potentially an option for you to be able to put away. It is important just to look at our contribution limits. This means how much can we put in total from employee, employer, and what's our Roth and pre-tax. We have had some changes right with 2026 and the new Secure Act. So I just thought as a quick reference, this is a great way to look at things. So again, for 2026, 24,500, max that employee plus employer, right? That would include that profit sharing, 72,000. You get a little bit older, we can have that catch up. So then you're up to 80,000. Great. Then you're somebody that's going to take advantage of that super catch up, even better. It's $83,250. So really, some really great opportunity here for people to put some money away. Okay. So other things that we can do outside of just doing a retirement plan. Probably one of the things that people tend to forget the most or just overlook are health savings accounts, right? So these are really great, right? They can be used with a high deductible retirement plan. So I'm sorry, a high deductible health plan. So remember, it has to be a high deductible, which is a lot of where I would say the marketplace has gone. So the HSA is also funded with pre-tax dollars. It grows tax-free, and it can be used for medical expenses. So right down here is a really good chart that goes over it. And the great thing about this that a lot of people forget, or if they're not working with an advisor, is you can actually save this into the future, perhaps into retirement, and use your past receipts to submit them. So again, it sounds like, oh, this is a lot of record keeping, but really pay for some health expenses now out of pocket, save those receipts in retirement when maybe you could use the money, or right, you've got a different kind of thing you'd like to pay for, right? You can start to use it, just pull out an old receipt, say, oh, we're going to use this one today. Here is our documentation. So again, one of the things that are just probably not widely used, and these are great for employees as well, can be payroll deducted. So this again is a really great tool. This one, maybe not the most tax efficient, but I think what a lot of business owners forget to do is you can use a taxable account. Here at Note, we work with a lot of business owners. I would say quite a few do take advantage of having a taxable account, right? So this is taxed after tax dollars, and this is outside of payroll and operating expenses. So really, this is building a separate account. What a lot of business owners do, this becomes a separate investment. Maybe we are only working with treasuries in it, or some business owners are more aggressive, and perhaps we're using some more ETFs or some mutual funds really to try to capture some more upside. Why is this good? It has the opportunity to outpace inflation, to keep up with inflation. So again, talking about inventory, if you need to cover some expenses for inventory, if you are looking at a profit sharing contribution for yourself, for your staff, right now we have the ability to have some more in here. It could be raises for individuals, so many different things, but also, it can be very nice when you go to sell your business to say, hey, we have this extra account. We can use it towards equipment. You might need it actually to evaluate your business. So there's so many different things that this can be used for. Next, we're going to talk about strategies to reduce your taxes through smart retirement planning. A lot of this is going to be some repeats from the previous slides, but really, if you really want to be smart about getting your retirement planning started in conjunction with your long-term plan to sell your business, utilizing that Roth option in the 401k is really going to be important for you. Remember, there's no income limitations to participate in the Roth 401k. Because if you sell your business and maybe you still get a salary, or you're getting repayments, or maybe you go on to a new opportunity, you can easily phase out. But now you have this Roth IRA that was funded from your Roth 401k. Another great feature is to offer in-plan Roth conversions. You do have to ask for this from your plan provider, but what this gives you the opportunity to do is to take some of those pre-tax dollars. Maybe you started your 401k years ago. This wasn't an option. Now we do offer it, and I would say most platforms do offer it at this point in time. You do have to ask, but you can turn some of those pre-tax dollars into Roth dollars, which is great. You will have to pay the taxes, right? But it does give you another opportunity to funnel money to that Roth. Next is to have a safe harbor retirement plan. Safe harbor comes with some specific provisions to it. We aren't going to go over those today. I do subsequently do other presentations where we do go dive deeply into safe harbor. But really the gist of this is it does allow business owners and key employees to fully participate in the plan, right? A normal 401k does have discretionary testing, and you need to make sure that rank and file are putting in. It is a fine line. So really, if you use the safe harbor provision, it really gives you the full opportunity to utilize your retirement plan. The next one is implement automatic enrollment. Again, with the Secure Act, if you're somebody new setting up a retirement plan, this is mandatory. However, if you've had an old plan, you aren't subject to the new rules for Secure 2.0, right? You can always add an automatic enrollment moving forward. This is really helpful for businesses that might not be passing their testing. Maybe they're having a hard time getting their employees to participate in the plan. And you, business owner, need this plan to work because you're trying to save for retirement based off of all those other charts we just reviewed, right? This can really help with building up the other employees' participation. When you're able, use those catch-up and the super catch-ups, and also look at the profit sharing feature. We have so many plans that say they forget about it, right? When we build plans here at Note, it's in every single plan that we have. It's discretionary. It's always there, but really this is going to be a nice opportunity for both you and your employees. Other strategies that are a little bit more complicated, but are ways to really start to plan for retirement smartly. One is going to be a cash balance plan. These have been on the market for a little bit of time now. And it really is a hybrid. So we're taking in conjunction our 401k plan that already exists. We're going to start to add a defined benefit plan to it. Defined benefit plan, the best way that people reference that is kind of like the old pension plans, right? We don't see as many today, but really what we've started to do here is to make it a great hybrid. These are plan sponsored. It helps considerably to reduce taxes. If you're a business owner, this can really help you apply more funds to you and perhaps to some key employees. Really, you've got a little bit more ability here. You can do age weighted, so if you're perhaps right the senior, more mature individual of the business owner, founder, right, we can do age weighted. Again, this is just a really great tool for retaining your top talent, getting new top talent, and really keeping those employees, right, giving them a little bit extra that have been with you for a long time. These are not ideal for everyone. So I always like to say that this does come with some additional cost, but this is really great for businesses that are really high earning businesses, a lot of medical dental practices, but we've seen more manufacturing, farms have gotten into this. So you've really seen a shift, closely held businesses and professional organizations. So again, this might not be a tool for everybody, but it is a really great tool. And you do have to keep it open for 5 years. This chart is terrific because it really says, wow, here's how it works. So again, over here is our normal profit sharing plan, right? It's flexible. We can be discretionary. We can have a safe harbor. Our employees are all participating in it. It's great. Here's our cash balance, right? This is our defined benefit plan. We can add more. So here we can put some additional contributions in, really accelerating those tax deductions more, right? Because it's that defined benefit. Think about those old pensions back in the day, right? We've got some predictable income coming. And again, ideal for high earners, partners, so on and so forth. It does have, right? Just going to reiterate again, it does have some more requirements to it. So it's going to add an additional cost in addition to that 401k, but really it can have a great benefit. And again, as we spoke, we still have the Roth option, really, and it's going to work for the enhanced retirement savings, and it's going to add some more tax deferral. Here's an illustration. So this one's also very helpful. So this is a little bit older, but we did say who's contributing. So here's our owners. We've got some non-owner HCE, which are highly compensated employees. So always with the jargon here. And here's our non-highly compensated employees. So we're going to call this our rank and file. Okay. Here's what their pay is putting in. These are their 401k. So this is what they're contributing to their 401k. This is a good illustration because this isn't showing everybody contributing, which is really, sometimes what happens. But when we're using the cash balance plan, right, we still have to utilize our profit sharing option in our 401k. So here's our profit share going to everybody. But the nice thing here is now we can skew some more profitability, a little bit more to our owners. So you can see here we were able to put right $120, $225, $150,000, right, age based. So here you can see that correlates with the age and the amounts. And it really, so suddenly we really start to see more options to put some money away. So, right, in our previous examples, we only had, right, 83,000. I think one was 55, right? So we were just using 401ks, solo Ks, but wow, you start to pair this with a cash balance plan. Wow, it really changes things. The next step I'll talk about are non-qualified defined contribution plans. So you've seen a little bit more of an uptick in these. And really, this is saying, hey, I'm a business owner, and these, you can discriminate in these. So, right, everything prior to this was you can't discriminate, no discrimination. But when you come, because this is non-qualified, right, now we can have a little bit more of a pick and choose. So a lot of these, we can build these out. These are documents. They are, again, come with an additional cost, but really it's the agreement of the business owner to herself, himself, and key employees saying, I'm going to set some money away for you for a future date, right? So it's a promise, but really, and these are funded by the employer, right? You can allow participants or employees to make contributions. That is very particular. We haven't done too many of those. The record keeping does get a little bit more complicated, but really, primarily these you'll see them funded by the employer. And again, you can pick and choose who participates in these. Where we've seen these become more popular are for businesses that are trying to retain perhaps some managers. They've got some project managers in construction. Really, we've got some, it's a family-owned business. We're trying to work on that as well. So again, you can discriminate, where in the previous ones you cannot, but really this is one we really work on, and we can make it very specific. The two primary ones are listed below. One is right to provide extra income, right? That's just specific to performance or retention, right? So again, kind of saying, hey, we're going to put some money for you for a later date, or hey, you really helped us bring in that sales goal, and you crushed it here based off your performance. We're going to continue to contribute for you. The other is restoration plans, right? We kind of talked about testing in the previous slides. So perhaps we had high earners, the plan wasn't safe harbor. There were some IRS limitations. So now that individual couldn't maximize the retirement plan. This is a nice way to supplement that. This is a little busy, but I thought it was a great way just to kind of look and say, hey, what's covered, what's not. So the non-qualified defined contribution, that's what we were just talking about. Then it looks at your regular 401k, right? No limits here for that example we just went over. No IRS requirements. So I think that's really important. I said you can kind of build this as you see fit. So this is a great way to utilize this where we do have, right, 401ks are very much regulated. So very important to keep that in mind. The other thing that a lot of people don't think about when they set up different types of plans, right? Your 401k is protected from creditors in the event of bankruptcy, whereas that non-qualified plan we just talked about, right, that's not protected. So additionally, right, you can roll funds if you're bringing on new employees, combining any old retirement plans, right? That all works in a 401k, does not work in the example we just went through. So I just thought this was a nice way to see some of the examples and the differences between them. Okay. Last section that we're going to cover is going to be on aligning your retirement planning with your succession strategy. Similar to when we first started here, start early, right? So you need to start that retirement planning right as you're starting that succession strategy. And really, a lot of stats say do it right away, right? You bought this business. How long do you want to be there? What do you want to try to save for retirement? When people come to see us, right, we have to solve for something. So really, what are we working with here? Come no less than 5 years, but really anybody that invests, no, you need 10 plus years. The sooner you can get started, time is on your side. So really start right away. Anticipate there's going to be changes, right? Maybe you start off with just a 401k. Maybe, and you can't afford to profit share or to match, right? That's okay. You can change everything along the way. Frequently, I meet with business owners that are like, okay, we have really, our profitability is great. We want to do something extra. Show us what that is, right? That's when we start to talk about those cash balance plans or the non-qualified plans we just talked about. Discuss with family members. I see a lot of spouses that come in and they're not in alignment. Perhaps one member of the family wants to retire early. The other family member is like, well, I'm enjoying this business. The kids are working with me. I love it. I'm going to keep working until I'm 70, right? So really have those conversations. And if your succession plan is to sell to your children, have that discussion with them and make sure, one, this is what they want to do. But two, as you go further down the road, that it's really amicable and on terms that everybody agrees with, because this can also help contribute to retirement. We work with another business where, right, part of the succession and, right, the father moving out of the business was that they were still going to fund retirement. So really, some really important discussions to have. Clear vision. This may change, right? If you're starting right away, this can constantly change. But right, who are you going to sell to? Is it employees? Right? Have you seen those employees maybe have more interest or really excel? So, right, if you have somebody that's excelling, you want to keep them. In the back of your mind, you're thinking that could be your succession plan, that cash balance plan, or right, the non-qualified plan could be fantastic. So now you're ready. Make sure you phase out gradually, right? You want to make sure that business remains profitable, particularly if we're using one of those plans outside of the 401k. Skills development, right? That's again just kind of identifying, maybe have somebody that could just use some additional training, particularly if you're starting so early. This can even be for yourself, right? I know not everybody is good at everything, so seeking some additional skills are always helpful. Structure your assets. Have your financials in order. One thing that we do see with retirement plans is, right, have we made all of our contributions? Have we used the best of the tools that are available to us? So making sure those are all in place and everything is completely up to date. And really engage with your advisors. When you're selling a business or thinking of succession, not only is it a financial advisor, a great accountant and attorney are going to be pivotal. Right. A few more things to think about from a retirement plan standpoint. Really get that safe harbor working, right? If you're a business owner and you want to maximize it, start that right away. If you can afford to do that, really, working with somebody like Note, we'll run the numbers for you. We'll kind of project out the best we can into the future. Use it. Start to really use your advisors, your trusted resources, get that safe harbor in place, and use that Roth option. That's there for you. It's going to be huge right into retirement. Utilize profit sharing options. Again, kind of talked about those, right? You don't have to do it every year. We can build it into a plan so it's discretionary. So, really maximizing those out are great. And again, consider those cash balance and the non qualified options as well. All right, that is all I have for today. But again, we are Note Advisors. We're located in downtown Buffalo on the waterfront, and we're always happy to help and answer any questions.
Thanks, Angela. That was great. Can you just share your contact information for anyone who needs it, if they email, phone number?
Yeah, I don't have it on a slide, so shame on me. But my email is Angela, Angela, at noteadvisor.com. And my direct line is 716-412-0063.
This was a great presentation. If anyone has any questions, again, you can write them in the chat or raise your hand. If anyone knows any business owners that could benefit from what Angela spoke about today, please don't hesitate to reach out to her, or you can email us directly at connect@noteadvisor.com, and tell business owners all about the wonderful things you learned today. And I will open it up to any questions if there are none. Thank you so much for joining us, and have a beautiful rest of your day. It's beautiful here in Buffalo. Thanks, everyone.